Hi, everybody. This is Giovanni. This is the Bitcoin Critical Pulse. That is a weekly show on Tuesday at, sorry, we are a little bit late, usually 2:30. And the show, just as an introduction, is me and Chris. Chris uh, is a traditional finance person with many years of experience, but he, he got interested in understanding Bitcoin using these tools developed by a French physicist called Sornet. He studied this log periodic power law, that is a tool to identify in advance, basically, it's a predictive tool, evidence for some big changes in the state of the market. This is something that is derived from his experience with studying other critical phenomena. These phenomena in physics are basically phenomena where you can identify different states in what you're studying. You have an after and a before and an after, right? Before there is some relative calm, there is nothing changing much, the system seems to be stable, and then all of a sudden something happened, right? This should remind you earthquake, exactly that, right? Nothing happens, bam, then there is something happened, right? But if you study and you focus on understanding the phenomena, you can see some signs that things were not that stable, the things were changing, and they were preparing themselves for this big change. And so, one just to give you an idea, one of the things that you observed was that there are oscillations in the buying and selling in the market. They are becoming faster and faster and faster, and if you extrapolate them to the future, at a certain point, they are so fast that they are unsustainable. And so, you can kind of tell when this particular event called the critical event is going to happen. You can make a kind of an estimate of where it's going to happen. And he was very successful. He showed that this happens also in the market because basically it's the same mechanism, right? Physicists are very interested in understanding mechanisms. So you can apply them to earthquake, you can apply to cracking materials and the market. And I studied the work. I was going to try to see if we could apply to Bitcoin, but I want also to have a practical tool that people could use, right? Not just something complicated that you can calculate offline. Is there a way of making it, for example, into a trading view indicator? And I knew that it was a challenge because trading view has a lot of computational limitations. But just in case, I look for somebody that could do it, maybe has done it, maybe finding some workaround. And this is how I met Chris. And I was very surprised because he had a very, very beautiful description of the indicator, what the indicator is about, and this entire idea of this critical phenomena in finance. It was it seemed almost written by a physicist. So I was surprised that actually Chris is not a physicist. So this is a compliment to Chris. And so we started to work together. Show me his indicator. We are compromise using trading view limitations and work them around. But basically, they do a very, very good job in bringing the spirit and the ideas of this approach in a very practical manner that actually people can use. So this is what the show is about. We discuss these tools, introduce them to people. We then analyze the market, show how useful they are to understand where we are, uh, and giving suggestion to people on how to use the tools. Later, we are going to show you our website where you actually can subscribe to use some of these tools. We will discuss it at the end of the show. But first, Chris wants to make sure that you understand this is not financial advising. It's just educational tools. Go ahead, Chris, please.
Thanks, Giovanni. Thanks, everyone. Not trading advice, not financial advice. It's for educational purposes only. Trading involves risk. Past performance is not a guarantee of future performance. The disclaimer's been up for a while. You've all read it, so we can move along.
Very good.
Okay, so this has been a weird time because we've known for a while that early to mid-September was one of these critical time periods for the long periodic power law. And we were sort of waiting for something to happen, but we weren't seeing the sort of classic agitated movement in price that you tend to get in the lead up to one of these critical time events. And we haven't had the usual sorts of signals manifest that you'd expect to see that would go along with it. Instead, we've had these kind of sideways movement with a little bit of direction, since last week to the upside. But it's not been clear. It hasn't been a good, clean, strong move. It's been back and forth. And I think a lot of people are a little bit frustrated that we haven't had some resolution here. So let's just do a quick recap. And you'll see on the chart, this red candle is where we were when we last spoke. And at that time, price was below this pulse LPP-LCP. We produced two lines with this critical pulse tool, the static and the pulse. The static being the slower moving one, and the pulse being the more reactive variant. And we were sitting right here. And at the time, I mentioned that sometimes when price crosses through the pulse, it gives us a sense of the direction that the market is likely to head. Well, we did have a cross a couple of days later, as you can see, but then we stalled and came back under, and now we're trying to push back through. So this lack of resolution, with any sort of definitive strength has been what's frustrating. And we had thought that, we might get some clarity from lower timeframes, but a couple of interesting things did happen. And on Tuesday, on this Thursday, Friday, we had an attractor level generated from one of our other tools, which we call the temporal phase model, which responds to shifts in the behavior of markets to generate these levels where price is likely to be attracted to. So this level of 118,542 was generated, which was encouraging for the bulls, I guess, in the game. And interestingly, today, on the weekly chart, an attractor at 123,414 was generated. And that happened sort of mid-morning today. So this is hot off the press. This is a new attractor level suggesting that there's more upside to the market on a weekly basis. Now, you'll notice also that we still have a valid attractor down here at 96,000 on the weekly basis. And these attractors remain valid until they're invalidated. And that means that there has to be price activity that causes this number to be eliminated and replaced with something else. In this case, it would be a level to the upside. So if price were to move on up to this higher level at 123,000, then there's a chance that this lower level would be invalidated and a higher attractor would be generated, replacing this P2 at 96,000. So this is all starting to get some form about it. And where it becomes more interesting is when we start looking at the lower timeframes, which is what we have here. So we have 8 timeframes from 5, 15, 30 minutes through 1, 2, 4, 8 hours and daily. And we've already spoken about the daily here showing 118,000. But what you notice with each of these lower timeframes is that for the first time in a while, we're starting to get attractors stacked to the upside. And it started earlier in the day with levels of the low 116,000s being targeted, all the way up to 117,000, 117,007, 117,006, 117,005. So when that starts to happen, and you also get confirmatory movements from both the static and the pulse in some of these timeframes, it's all suggesting that price is starting to resolve to the upside. And then if we go back to the daily, which we have here, you'll see this state table at the bottom of the page here, which is showing the 1, 2, 4, 6, 8 hour daily, weekly, monthly state. And all this table is doing is replicating in sort of color-coded format what the static and the pulse are doing for these different timeframes that are noted here. And you can see that they've all started to move into bullish territory. So they're all stacking in the same direction. Some of the other tools that we have that we're using, this one here, which is the scale convergence overlay, does a similar thing. We look how it resolves through different time frames and at the sort of micro, meso, and macro level, and they're all turning positive. So on balance, these are things that are all starting to suggest that we might get resolution to the upside. But in reality, the thing that's kind of interesting is that tomorrow is when the Fed announces what it's going to be doing with interest rates. It's probably going to be cutting by 25 basis points. That's what everyone is expecting. Those who are a little more bullish are expecting 50 basis points, although that may be hard for them to justify given the retail sales numbers that came out today. It would be sending a message that would probably confuse people a little bit if they went 50 basis points, but 25 is what's expected. But were it to be something other than 25 basis points, I think that would be a catalyst for movement in markets. And that could be what sets us off to the races here tomorrow. Remains to be seen. It's not a prediction. It's just the reality. We have this event tomorrow that's likely to cause some action, and that's coinciding with these moves that I've just described occurring at different time frames. One of the other things that I did when we were having this sort of period in the doldrums to try and understand what was going on was look at some of the tools that we're using in addition to the LPPLCP, the static and the pulse. But some of the other tools that we're releasing, we have this one with the yellow bands, which is called the core line. And it establishes attractor levels that the market's drawn towards, and it kind of either absorbs all of its energy and repulses price back towards a more central attractor, or price overwhelms it and actually powers through. And it's analogous to the osmotic process in a cell wall or an energy transfer type thing. And it uses a couple of different methodologies drawn from different scientific disciplines. Similarly, the scale convergence overlay is really designed to respond to shifting structural influences in the market. And what I thought I'd try and do was identify periods when there's confluence between these tools that would suggest a strong move, or give me some clue as to why things were panning out the way they were, because we weren't getting enough clues from both the static and the pulse parallel lines by themselves. So you'll notice here on September the 1st, I've got two areas circled. This is when the scale convergence overlay switched from bearish to bullish, and when price was repelled from the core line down here, and then it bounced off that pretty aggressively. At that time, there was no confluence signal from either the static or the pulse. They were both remaining bearish, yet price moved up from these levels. So in exploring this a bit more, I wanted to find incidences of three confluent events, one being the static separating from, the pulse separating from the static parallel line, another being repulsion from the floor or ceiling of the core line indicator, the yellow lines that fade and in and out depending on their strength, and a shift in this scale convergence line. And I found that about once a month, going back over time, we get events that has confluence where these three separate indicators arrive at the same conclusion at the same time. And we're going to talk about this a little bit more with some of the tools that Giovanni has been working on as well, where we're taking the parallel line, the LPPLCP static and pulse, and laying it on top of the work that Giovanni's done to see if we get additional confluence. But just to illustrate, you'll see here on August 14th, we had three confluent events: the separation of the pulse from the static, the repulsion from the core line price level up here, and a change in the direction of the scale convergence overlay here. And similarly, we had that occur here. We had it occur here on June 24th, on May 22nd, April 8th, and so on back in time. This happens again and again, approximately every 4 weeks or so, give or take. Sometimes it's 3 weeks or 2 weeks, sometimes it's 6 weeks or 8 weeks. But these three things seem to be very, very powerful, and it's something that we're going to be doing a bit more work on to try and understand. But when three totally separate methodologies grounded in different scientific disciplines reach the same conclusion, that's when we start to get a bit excited. So we don't have that happening at the moment, but what we do have is these stacking of targets and attractors from the temporal phase model that we use, and these higher attractors in the 1 day and 1 week, which in some suggest that the market is gaining a head of steam that could well be pushed a little bit further if we get some good news from the Fed. So I'm going to leave it there, and I think, Giovanni, this is a good time to go and have a look at some of the tools that you've been using and developing, and how the LPPLCP, static and pulse, work in conjunction with that new tool of yours.
Yes, fantastic, Chris. Sorry, I was muted for a second. Okay, this was a very good analysis. I want to show you. I'm going to share my screen now. First of all, I'm going to tell you about these indicators that I'm developing, and then I'm going to show you how they look when superimposed with these log periodic power law tools that Chris is developing. So what are you seeing here? Let me explain what did I do. So this is I already work on this particular topic, but I'm going to make it kind of a central thesis around the power law. That is, I think it's even, it's all combined, right? Like Chris said, you don't want to arrive to this kind of understanding just from one side. You want to do it in 2, 3, 4, 5 different ways. So sometimes people say, oh, you just found some regression line. It's silly, because I actually, in fact, today I'm going to post a Medium article showing all the different ways I prove Bitcoin is a power law. Probably I did it 7 different ways, using network theory, all kind of things like that. But one of the latest powerful ways is we look at the returns. It is a classical parameter that people study when they publish papers in finance. They look actually what is called the log of the returns. The log returns. And return is basically price today over price yesterday, right? If you express it as a ratio. So if you make a chart of that, in fact, one of the indicators that we have in our set of power law indicators, you can subscribe to them through Patreon, is a chart of the returns. You can see how the returns look in time. So if you do a moving average of these returns, you're going to see very clearly they are decaying. These are the famous diminishing returns that we mention all the time in Bitcoin. It's not just that the peak are becoming smaller in the cycles, but the entire returns. If you calculate the annual return 10 years ago versus today, it's different. In 10 years, for example, the returns right now, we are around 45% a year, are going to be like 22%. In 20 years, they are going to be 17%. It's actually, they are diminishing, but this process is also slowing down. So it's not a good parameter because it changes in times, these returns of Bitcoin. Is there a way of finding a parameter that has been stable, right? One could say, well, the power law is stable, but it per se is not a statistical quantity. So if you take the returns and you divide it but what is expected to be the returns of Bitcoin in time from this theoretical formula. What you're going to get is like a normalized return in time. That quantity becomes stable. I call it mu. It's basically a slope, right? It's this local slope. So imagine I fit every single day with a power law. It will give me a value for that slope. That slope can be 200 or minus 200. It usually ranges between these extreme values, 200 to minus 200. Now, if you take literally the average of all these values over the entire history, you get 5.9. And this is what you're seeing here. This orange line is where zero is basically, if you are below zero, means you have a loss. You can see when we go below zero, basically is when we go down and we have a retracement in the price. But the average value of these slopes is 5.9. That corresponds also to the slope of this red line, that is the power law. If you draw a graph of the log of price versus the log of time, you get a straight line, and it has a slope that is close to this value. But here we are recalculating it in a completely different way, right? We normalize the returns, then we fit. You have a distribution of these values. It changes quite, by a big amount, minus 200 to 200. But then the mean is not zero, of course, because Bitcoin goes up in time. It's 5.9. Notice how this value doesn't decay, doesn't change in time. It's the same. This blue line, of course, it's a statistical quantity, it's a stochastic quantity, is going to fluctuate, but it fluctuates around this orange line. And this all the way to the early history of Bitcoin, right? This is 2010. You will have a hard time to find a regression line that follows the power law just using the first couple of years, because the data was so strongly dominated by the bubbles that it's very difficult to fit a power law there. You will have to use much more data. This power law, the regression started to work since after 2017, 18. But this quantity was there, and it was doing the same thing from early on, from the first days. Now, what I'm also showing is the range, right? So I'm using what is called a T-location distribution. So I'm not using the typical bell curve. It's a distribution that is much more narrow at the center and has the AV tails. So large values are more likely than if you had what is called a Gaussian distribution, the bell curve. So I'm using the proper distribution that seems to be a very good fit to the data. And here I'm showing the equivalent of sigma. So plus sigma and minus sigma. You can see the variation, right? The changes during the bubble. Let me see if I can show you the real data here. See, when we have a bubble, this quantity mu starts to spike. Sigma also spikes. You see here one of the earliest bubble, another bubble here. It goes up. Now, something strange happened, and I was discussing this with Chris. We need to explore this. Why, after 2017, see this how this green line also fluctuated with the plus one sigma, but it kind of stays stable around a single average value, right? Around maybe 45, something like that. Then we can say 70. In 2017, just before the bubble or during the bubble, there was a huge big jump. And then you see how it stays stable, right? Around this value that is about kind of 86 or something. So since then, of course, during the bubble, it starts to go up, but you see in average, it's stable over time. So basically, this means that, the 2017 event is here. Here is the second bubble that we had. So it jumped and it stayed around 186, right, in average. So it's pretty cool because this means that Bitcoin has basically done the same thing for 8 years in a row. So mu has been stable for 16 years, but the sigma, so the variability of this fluctuation jump, that is actually counterintuitive because many people think that Bitcoin is more, is less volatile now. I think this is because the returns are diminishing. So in absolute values, yes, but in relative values, if you take this parameter mu and consider the decay of the returns, no, actually the volatility went up. It is interesting in terms of this parameter, right? But it stays stable since 2017. So Bitcoin is really an extraordinary result. Bitcoin has done exactly statistically the same thing for 8 years, has no change. It's just crazy. It's a very powerful thing because this gives us confidence that Bitcoin will continue to do this for the next 8 years. That will bring Bitcoin to 1 million. So if Bitcoin does the same thing that it has done for the last 8 years, we reach 1 million Bitcoin. It's just incredible. Anyway, so what you can do to use this parameter in a practical manner, you can calculate this quantity, the same quantity mu, that is basically the mean of a distribution, on a much smaller scale. Here, before, the blue line was calculated over a period of 30 days. I'm calculating mu now over 3 days. And this gives us a sense of the changes of this quantity on a much shorter scale. Now, I kept the sigma 30, and you can see the intersection of this yellow quantity in the upper level, that is plus sigma, and lower level, minus sigma, give us very good signal. They give us buy and sell signal. They are candidate. Then you can make a strategy. You can pick the first one of these sequence of signal. Like, for example, here you see I have a long, here you have a sell, right? So I show all the candidates in green, but the little arrows, blue and red, show where the real entry, because I made it into a strategy. In TradingView, you can say, I want to trade with these. And in this case, maybe it's not optimized, but we are choosing the first one that appear in a sequence. When we have the first red, we sell. And this, even without optimization, this strategy has a 77% success rate. It means that 77% of the time you actually had a gain, and your gains are 3.6 larger than the losses. So it's a very strong, powerful trading technique, even before optimizing it. Now, if you combine it with the indicators that we are developing, the log periodic power law indicators, it's incredible. Look at this, right? So the simplest way that I can explain you is that when there is a convergence with these white lines, right, basically you have a buy signal. Every time you have this white line, and the way to do it, I think in general, right, will be to do a trade when you see the white line appearing. Really, the confirmation is the separation of these two power laws. That is when the signal is confirmed. But in general, you don't really need even that. You just can do it every time you see the appearance of a white line. That is when basically something is changing the market. And if we are going down, well, can it change? Well, we are going up, right? So you know in which direction it can happen. Like here, for example, you see it identified local maxima, here identify a local minima. We are in perfect agreement here that this was a good buying place. It's the local minima of this change here, and this will have been a good selling point. It could have waited for the end of this white signal of a divergence of a two lines that happen actually all the way here. So combining them together, and Chris can correct me about this, right? Because he knows how to interpret this signal together, but much better. But it's really a powerful combination, and we're going to work in making them combine even better. And it's interesting because it's a completely different way of doing this analysis, coming from different direction, and they converge. Let's say basically the same thing. But where my indicator sees green, the log periodic pulse sees green, and vice versa. I will have to say, in general, the critical pulse is actually so precise. It's actually finding the peaks and the bottom with even higher precision. But there is something about combining different indicators that are really coming to the same conclusion from completely different places and making them work together. This is what we are going to do next in improving even more these tools. Chris, do you want to comment on this?
Yeah. So this is something that Giovanni and I have just really started working on recently. The confluence of signals from these two tools, and there's a lot to it because the relationship of the static and the pulse and price, whether one is above the other, two, any two are above another, the slope, the degree of separation, the width of one from the other, all those various combinations and permutations, of which there are a very large number, needs to be refined down to sort of quality signals. And there are certain things that we look for, and you can see in Giovanni's chart there. I'm not sure what it is. I guess it's maybe around April. You can see the green dot there, Giovanni.
Yeah.
You can just blow that area up a little bit.
April 1st.
Yeah, you can just expand that a little bit so we can see it.
Yeah.
What you'll notice is that the pulse has separated quite aggressively from the static and is accelerating away from the static fairly powerfully. So very early on, when that separation occurred, and you have the confluence of the signal from Giovanni's methodology, that's looking like a very promising set of coincidences that could be traded quite well.
Yeah, and you can see what happens here, right? So basically, the short-term scale distribution went so far away from what is usual, right? Because you can see here, for example, it's telling us, okay, minus 148 in terms of a value of this slope, local slope. It's a pretty high value, and we start to deviate strongly from that, right? So we kind of cross it. That means it's a mean returning process. And, Bitcoin, remember, the power law is an attractor. It says, I'm going too far away from the power law. I want to go back to it, And you can see this is exactly where this minima can be found. So if you have these two together, you're starting to improve your conviction that something is happening. These indicators are firing, say, listen, the market is ready for a change. You know exactly what kind of change, because where are we going back? We only can go up, right? Because we went too far down. And once you have a conversion of these, I mean, it's amazing, right? This was 76, and we knew, all the indicators say we are going too far. We are going to correct. It will have been if you, and what will you have done? Again, options, right? You could do options. You could buy option. This will have been a great place for a call, with maybe IBIT or whatever. Or you can buy futures. You can buy a future contract, maybe with some kind of a leverage. Don't do anything stupid, like 100 per leverage. Do a 5 per leverage, and you could have cashed in here and made serious money that you could have used, because on exchanges like, by the way, Coinbase is testing futures contract soon. There is a beta testing, so this will be also something that people from the United States can do more easily, because we cannot access a lot of the exchanges like Bybit and so on, given to the stupid regulation we have. Sorry if I say that. It's now a vice, right? So I can express my opinion. These are stupid regulation. Hopefully they change. But Coinbase is starting to have future contracts. And so you could buy a future contract with some leverage, 5 pair, for example, and cash in here. Even if you cashed in here because you wanted to go with the first white line, you say, I want to go with whenever the white line appears, you will have cash in here. Pretty good gain. Now, you could have waited for the separation of a two pulses, right? And then you could have cashed in here instead, right? It is still amazing. So,
well, so there's a lot of work that we have to do on this.
Yeah.
And the point is that there are some pretty obvious places where the two indicators are generating coincident signals.
yeah,
And we need to explore why that's happening, how often it happens. Is there any relevance to it, or is it just an artifact that we're drawn to because it looks good on
yeah,
a set of visuals? So that's the work that we have to do going forward. But
yeah. Measure it statistically. Like for example, like when they did this success rate, right?
yeah.
It's proven that 77% of the time it
Yeah.
works. I think we can improve it even more, combining these two things.
Yeah.
It will really.
And I think some of the other tools that we have that are coming on stream would be additive to that. And if you take those sets of three confluent events that I described earlier on the tools that we have coming on stream from Complexity Trading, with this tool from Giovanni and maybe some couple of others,
Yeah.
It may be that the signal frequency is not that often.
Yeah, you don't need to, right?
You don't need
without
to.
being a big trade, like a huge percentage.
Huge trade.
Gain.
But here's the other thing that's quite interesting. We know that there's self-similarity with these signals. So the suite that we have from Complexity Trading, all work across all time frames. And for those of you who've been following the LPP-LCP, you know that the patterns that we see just recur, again and again, but across different time frames. Sometimes with a little more noise at lower time frames, but they do repeat very, very significantly and frequently. So the question now will be, can we apply Giovanni's methods to lower time frames, lower than 1 day, and see if we can find additional evidence of self-similarity with that tool?
Yeah, absolutely. Yeah, I'm very excited. I think these are really unique tool because I studied all these TA tools, like even Bollinger and Barnes, that is one of the most scientific tool among the set of TA. They don't work because they are always delayed. One time I was so excited because I found this engineer, John Ehler, maybe you know him.
Yeah.
He wrote a bunch of books like, Trading for Rocket Scientists, etc. I say, okay, finally somebody that is bringing some scientific rigor to this approach. And, he did some interesting things like for example, 50% of my dissertation was in this field called signal analysis. That is basically what I'm a physicist, but I did some applied physics. So I had to understand what is called signal analysis. It is, Fourier transforms, and time series. That was the topic of my 50% of my dissertation. The other one was theoretical astrophysics on neutron stars. I did both, right? Because I wanted to be knowledgeable about both fields. And Heller brought that terminology from signal analysis to trading. So he talks about a very, very scientific language, but it still doesn't go away from this thing where you still have delays, and look, in communication, in signal processing, you always have delays. Now, it depends if you're looking at signal in real time. You cannot eliminate this delay. You have to live with it. But, you can still work with what you have. With trading, it's almost a deadly thing because if you are, it makes a big difference to determine if a signal is here. Like, look at this. This is when you will have acted, maybe 1 day later if you wanted confirmation from these two curves separating. But it makes a big difference if you do it here or over there, right? If you do it over there, you
Sure.
lost 50% of the potential of this trade. And this is what is my experience with all these TA indicators. We have such big delays that by
Well,
the time the signal is confirmed, it's basically over, and so there is no, you cannot act on them really efficiently.
well, it's I agree with you. I don't have a lot of time for technical analysis. We've spoken about this before, but the reality is that almost all technical analysis is price based, and price is these days an artifact of structure. It's the footprint left behind everything that goes before.
Exactly.
And the tools that we're using now that we're trying to bring to Main Street from Wall Street are tools that look underneath the hood and understand when the fractures are occurring in the structure that causes price to stack in a particular way, or move in a particular way, or break in a particular way.
Right.
And none of those tools are used in traditional technical analysis. So when you get stacking of or coincident signals in technical analysis, it's again stacking of signals on an artifact of something that's already discoverable. But that's not what it's using. It's not using the discoverable piece. It's using the footprint of the discoverable piece.
Absolutely.
So it's delayed. It will always be delayed, and it will continue to, ultimately vanish into irrelevance.
Yeah. Okay, very good. Let's see if we have some questions. Classical Italian. It was late. Yes, my fault.
So what do you think about this network question? I mean, to me, it seems like, you need to define network, because we're sort of mixing fundamental forces of nature here with a man-made protocol.
Yeah, so it turns out almost all the law of nature, like a huge big number of them, but it's a long list, including gravity, because gravity basically it works this way, right? You take if you want to calculate the gravity between two objects, that every object has gravity, even two bottles attract each other. We don't feel it because it's so small, and friction in my hands is so big that overcomes these attractions. But if I put this in space, they're going to come close over some amount of time. Not even, I think if you put,
I hope those are vitamins.
They are vitamins, yes. So if you put them 1 meter along, I don't remember the calculation, half an hour before they touch or something like that. But the main equation says multiply the mass and divide it by the square of the distance. That is a power law. Electromagnetism has the same equation, basically multiply the charges divided by the distance square. Power law. How much light is emitted by an object that is glowing, right? If you have the sun, but also if you see the filament in a bulb, how much light is emitted is proportional to the temperature to the fourth power. It's called the Stefan Boltzmann law. Power laws. Now the question is, if there is some link between network properties and power laws, because they tend to organize themselves. In particular, if you have like a node that is called preferential attachment. If you have a node that is very strong, like for example some whale, in the market, or somebody that has a lot of influence, because it's not just buyers that matter, also influencers. Like the show is a node, where you have many more people linked to us than everybody else linked to each other, right? The system will tend to show power law properties. The number of users grow like a power law. For example, the internet itself grew as a power law of 3. Bitcoin grows as a power law of 3 in terms of the users. It's crazy. Viruses spread like the power law of 3. So a lot of processes, right? With the force of nature, it's possible that they are network too. Like we don't know, maybe how gravity expresses itself is a network. And there are some people, like for example, Wolfram, he's developing this idea that all the laws of nature are coming from the network of all the possible allow laws, and then some of them are selected, all the possible rules, right? He has like a diagrams where you look at all the possible rules, and they form a network. I don't have a book here. I can show you next time. It's fantastic. So he has these ideas where he's trying to derive the laws of nature. In fact, he has a derivation of how gravity works using network theory. It's an indication that it is possible. Everything around us is a network, including the most fundamental law of nature. But we are not there yet, right? It's mostly very abstract ideas. Somebody's trying to show that, yes, you can, by developing a network theory of the laws of nature, you can derive gravity, electromagnetism, and so on. And that will be fantastic, because then Bitcoin is another of these expression of how nature works that prefers power law. Power laws are really the only function that has this scaling property, and scaling is everywhere around us. So we don't know. We don't know if they are power laws, and we don't know if the laws of nature are due to some kind of underlying network of possibility, let's say, or the fabric of reality that maybe is a network. We don't know. There are some proposal that is the case. So it's very interesting. But in general, what I will say is that these power laws show up everywhere. As far as I know, Bitcoin is the only asset that has these long-lasting power laws. Sornet shows that when you are close to a critical event, you see power laws also in normal financial assets. You can apply these things, these tools, to gold, to stocks, to any other assets, because just before a critical event, the price tends to be a power law. And that, again, is another thing that we observe in nature, that power laws are expressed in the phenomena. Just to give you an example, maybe we can move forward after this. If you take one critical phenomenon that is kind of almost classic, right, that studied a lot, is when a liquid goes from liquid to solid, right? And that for water, for example, happen at 0 degrees centigrade. When that happens, when you are very, very close to that critical temperature, this is called, no, by chance, because it's a critical event, and you're looking at the water, you're going to see the ice is being formed, right? Now, people study this, and if you zoom in with a microscope and you make a graph of the size of these clusters, and you put that size on the x-axis, and then you calculate, by counting, etc., statistically, how many of these clusters there are with that size, what you're going to see is a power law. There are a lot, you're going to have a lot of small little cluster, few large one that you actually can see with your eye, and they organize themselves like a power law. You can take the log of a size versus the log of a quantity for each size. You're going to get a beautiful power law. They show up everywhere in many different phenomena. When you go from liquid to gas, when you go from liquid to solid, the fog itself that you're seeing is why, for example, milk is white. Is exactly because of that. If you look at all the different particles of milk, you're going to see large particles, small particles. They are scaled up, and that scaling then block the light. That is why you see why milk or fog are not transparent, right? So that is beautiful. But when physicists find stuff like that, they go crazy. Like this is why Sornet work is so relevant, because it applies to earthquake, it applies to crack, it's applied to the market. We call this principle universality, where many different things that seem very different behave in a similar fashion. Of course, with differences, because the market is not exactly like an earthquake, but it has similar properties. But it's a very powerful approach, and this is one of the things I'm trying to teach people and make them see Bitcoin in a different way, because it has properties that other assets don't. You want to say anything about this?
Well, I'm a bit short on time, but I would just say that, yeah, I mean, it's a network, but we really need to define network, because, a jazz band or a family is a network too, but totally different. So in the context of a network expanding the way Bitcoin has, and the users expanding, that adds value. The larger the network, the more interactive it is, the more value it has. So it's an interesting discussion. It's one that can go a whole bunch of different ways, and you've raised a whole array of points we could talk about for an extended period. There is another question that's come up that I'd like to address before we wrap up, from Bitcoin Jake. The user interface is very easy to use. It's pretty straightforward. You can do things to enhance the visuals, which you can do with pretty much every tool that's available. But the inputs, the default inputs are created to work for crypto. They're optimized for crypto. Crypto has unique volatility characteristics, so you don't really need to tamper with them at all. It works pretty well for all the cryptocurrencies and related instruments. I would say it's no more difficult than other tools that you currently might be using on TradingView. Very simple, very straightforward. And in addition, we have a Discord and support infrastructure. There's a manual, some background technical stuff that comes with the subscription that describes the theory and the general methodology that's deployed, together with an analysis of how to interpret signals and how to think of them. And it's important to note that this is a totally different way of thinking. Giovanni mentioned the white lines earlier. So we think of markets as either being in a state of indecision, where it's seeking resolution, or where they have conviction and are moving in a particular direction. And they're the only two things that matter. Is the market confused, or is it moving with conviction? And if it's moving with conviction, the direction is clear. And those two things are paramount in how you think about markets going forward. You kind of have to unlearn all of the technical analysis stuff that you've learned and understand that the things that really move markets are structure. Structure comes from so many different and diverse components that we're looking at, and that can be modeled in different ways and brought to the surface, so that we can see what's really underpinning the movements that are occurring in the markets from time to time and across different time horizons. But all of that information is available. It's something that we discuss regularly in the Discord channel. It's an active community of people who are engaged in this new way of thinking about trading.
Fantastic. Do you have a couple of minutes just to show how people can access these tools if they want to subscribe to it?
Sure, real quick. We'll do this.
Okay.
So if you go to the website, which is complexitytrading.ai, you'll come to this page. If you put your email address in up here, you'll get access to our newsletter, which is free. The first edition of that went out this past week.
Yeah, by the way, please subscribe. It's free, right? So if you want to keep updated and so on about our progress, subscribe to the newsletter.
And then
we just sent the first issue a few days ago.
And then if you scroll down, you'll come to, there's a little bit of information about what we think and what we're doing. But this section here describes the various tools that are being released. The first one that's out is this one, the log periodic parallel or critical pulse. And it's the one that was profiled in Giovanni's tool just now. And
just click on it, and
so you click on it, you get this little prompt that comes up, and you can learn more about it. So it tells you a bit more information about what it is and what it isn't. And you can click the subscribe button, and it takes you into this area where we take all your information and process the transaction. Include your TradingView username so we can send an invitation and get you access to the tool. The rest of these tools are coming out. There's 4 or 5 of them that will be coming out literally in the next week or so, and the others subsequently. But the more powerful ones that you've seen profiled in today and some of the earlier episodes will be out very shortly.
Perfect. Okay, great. I think this covers everything.
I think there's one more question, Giovanni.
Oh, yeah. Great.
So Minotaur is a different group that Giovanni works with. Their subscriptions are quite different from mine. It involves an algorithmic bot and dollar cost averaging methodology. I don't know the details.
They are
of their
very different and complementary in the sense that what Minotaur does, it's waiting for the price to. It doesn't predict anything. It reacts to a price, but it does it in an intelligent way. Where if there is a retracement, we basically try to DCA down using modification of what is called a martingale, and then at the first opportunity, when the price recovers, we sell these future contracts. So it's a different approach, and all these tools are very complementary. The bottom line, we are trying to tell people that the time of hodling is over, right? So at least just hodling. You need to have different tools to try to get some kind of a minimal yield on Bitcoin. You own your Bitcoin, you can, for example, you could use these tools that we are describing here to buy future contracts. It will be something that you have to do manually, but the entry level is completely different. What we're offering here is very, very affordable, very simple to use. The Minotaur is something for, let's say, a more advanced investor that has the resources because to be honest, it's a high ticket kind of product, while the prices for our subscription is super affordable and reasonable.
Yeah. So
actually we are giving it away in a sense.
Well, I mean, that's the whole idea. I mean, these are tools that have been available in different forms on Wall Street for many, many years. I'm trying to bring them to Main Street.
Yes.
So these are monthly or yearly subscription at your discretion. You can unsubscribe at any time. Mix and match these tools as you see fit, and it's all very affordable. The LPP/LCPs, $105 monthly or $1,000 a year, and there's a group of people already actively using this. We're not distributing this massively. It's very controlled early distribution, so we can respond and make sure that we've got the rollout working the way people want it to work. So very interactive with users, and a number of those users are working to include the signals from this suite of tools into their bots and their various trading algorithms that they use. And
eventually we could develop our own bots based on this strategy. We are now there. We want to make sure that we have a very strong signal that converges with other, and then later we can look into making it an automated strategy, right?
Yeah, very, very simple. If you're a user of TradingView,
you can generate signals. A signal can be
total walk in the park.
They can be automated with using 3 commas or something like that.
Yeah.
Then we will see if there is like Coinbase maybe can be connected to it. But these are things that are in we are thinking about them, but eventually we will develop.
Okay,
guys. Thank you so much to follow us for today, and we will be there. We will be here next week, same time, same place. Bye, everybody.
Bye, everyone. Bye.